As we move into September and kids return to school, the early August meltdown is now a distant memory, with equity indexes having quickly rebounded back to all-time highs. Then markets staged a choppy recovery, even notching the strongest week of the year along the way. Despite renewed recession fears, fresh data seems to have eased investor anxiety and boosted hopes that a recession-free, soft landing is still achievable. That's good news for markets, but there are plenty of risks to watch. Inflation continues to head downward, which is good news for consumers and supports the case for more interest rate cuts this year. Other economic data is also showing optimism. Retail sales have jumped unexpectedly, suggesting Canadian consumers are doing better than expected. Analysts currently expect the Bank of Canada to cut interest rates again in October. The unemployment rate ticked up in August to its highest level since October 2021, and the job growth slowed more than expected. That's not entirely surprising, since the labor market has been recovering from pandemic disruptions. If the labor market weakens and Canadians start to worry about their financial situation, it could erode consumer confidence. Markets are likely to remain volatile in the coming weeks, especially given the focus on the economy, interest rates, and the upcoming U.S. election. After falling for 4 straight days, the Dow dropped 400 points, ending the worst week since 2023. Stock volatility is spiking. Nvidia, once driving the market surge, is down 14% and falling. Don't wait for the next downturn to safeguard your assets. Move into reliable, safe haven assets to protect your portfolio from the ongoing market turbulence. From a big picture perspective, excess money supply has been steadily declining, while consumer assets like savings have fallen below historical average levels. We also are in the beginning of a slowing employment picture, with job openings declining to near pre-pandemic levels and unemployment levels increasing. Lastly, from a credit perspective, banks have increased loan provisions with the expectation of increasing defaults as auto and mortgage delinquencies have increased. So clearly, many of the things that drove consumption in the last few years are moving to trend or below trend, which is calling into question market valuations. Investors tend to benignly neglect their portfolios at times like these, when returns are there for the taking. A simple portfolio of index tracking exchange traded funds, weighted 60% to stocks and 40% to bonds, could easily be up close to 10% for the year to date. Some questions you should be asking yourself. How much exposure do I have to the S&P 500, NASDAQ, or equity funds with similar holdings? The recent plunge in the S&P 500 and NASDAQ highlights the risk posed by the fact that big tech stocks have been driving the U.S. market returns. It's time to consider how committed you are to holding through potential volatility ahead. Here's the truth that might surprise you. No one builds significant wealth alone. Every ultra-wealthy individual, from Warren Buffett to Oprah Winfrey, relies on a team of financial experts to help them make smart decisions, optimize their finances, and protect their wealth. These people don't have all of their money in the stock markets. They're smart people, and they've discovered unknown fixed income assets like tax-exempt dividend-paying insurance contracts to protect a chunk of their capital. Your wealth team might include a financial planner to oversee your financial objectives, a CPA or tax specialist to minimize your tax burden, an estate planning lawyer to protect your assets and your legacy, a financial planner to maximize your income streams, an insurance expert to safeguard your wealth, and a portfolio manager to guide your investment strategy. At McGuire Financial, we have a group of experts who do all of this and more. We work with you based on your unique needs and in alignment with your personalized wealth objectives.